The third quarter bond market can best be described as living the dream. It was another quarter of solid returns as the sleeper bond bull market rounds out its second year. What's unusual this time about the bull market is that the solid returns haven't been driven by a sharp drop in rates, but rather just by simply earning the yield itself and the boost returns from the narrowing of credit spreads. Looking ahead to the near term, with geopolitical risk running high, as well as in many countries like the US and France, plain old political and policy risk running high, markets may be more subject to either bouts of volatility or, in light of the strong recent gains the last 2 quarters, consolidating some of the gains to date. In short, it could be time for the bond bull to take a rest. Looking further ahead, though, the long-term outlook remains favorable. Growth and inflation are moderating, but not so much as to threaten credit fundamentals, which remain positive. Meanwhile, central bank tightening has given way to rate cutting cycles, and this is heightening fear of declining cash yields. This in turn is fueling a search for yield trade, where investors move out the yield curve and down in quality in order to lock in yields for the long term. This hunt for yield should keep a lid on both rates and spreads, allowing the bond bull market to continue, albeit with intermittent volatility stemming from the vagaries of economic data, geopolitics, politics, and policy. While no doubt unnerving, this uncertainty and volatility continues to create opportunities to add value through active management. As always in our quarterly, you'll find our analysis of the evolving economic themes driving the markets, as well as quick dives into each of the fixed income sectors, highlighting both sub-themes and where we see value across the fixed income markets. Check it out at pgimfixedincome.com. Thank you.